I am Brian Briscoe, the founder of Streamline Capital, and with me we got Stephen Richards. We are going to be discussing the Salt Lake City portfolio for you tonight. It is a multifamily investment opportunity. Really excited about this deal. Very excited about Salt Lake City, in general, and very specific about this deal. Now, this is a 506C investment opportunity. What that means is you have to be an accredited investor to invest with us at this point. And we're asking minimum investment of 100,000. We'll talk about numbers all throughout the presentation, but we are projecting about a 16% internal rate of return. I know some people aren't familiar with what an IRR is compared to an average annual return. This one is the easiest one to explain. Average annual return. You take up all of the money, that we're going to give back to you. You divide it by the amount you've invested, and you divide it by the number of years, and that's the average annual return. The IRR takes into account time, right? So basically, you compare these two numbers together, and IRR is always lower than the average annual return because it's discounting your returns based on when you get them. So it's basically saying a dollar today is worth a dollar a year from now is worth 97 cents. Okay, is how the internal rate of return computes things. Okay, cash on cash return, this is the profit, the returns coming from the operations on the property. And the equity multiple, this is what we're returning to you. So if you invest $100,000 in this deal, over the course of this project, we should give you 100,000 times 2.96 back, which is just shy of 300,000. Okay. All right. General disclaimer. All right. Basically, what this says is, we can't guarantee numbers. We are making projections. We are doing the best we can to project things accurately, but I do not have a crystal ball. I can't predict the future. Therefore, we're not guaranteeing anything here. Okay. We are doing the best we can to make reasonable and accurate projections, though. All right. So let's talk about the highlights of this property and go from there. So first of all, 80 units in South Salt Lake. If you're familiar with the Salt Lake Valley, South Salt Lake is the city immediately to the south of Salt Lake City. And this is technically in the city of South Salt Lake. If you're not familiar with it, just think, hey, this is Salt Lake City. It is in the Salt Lake City metro area. And, you wouldn't know it if it wasn't for signs. You wouldn't know it when you left Salt Lake City and entered the city of South Salt Lake. All right. What we have is a 2-property portfolio, total of 80 units. All right. And one thing to note about the 80 units is I think this is a really good way of getting the best of both worlds. Okay. What do I mean by that? When you're managing properties, there's kind of like this dead space on management. And that dead space is kind of that 20 to 70 units where it's hard to manage the properties. Okay. Well, we've got 2 properties together. They're about a mile away from each other. Stephen and I have both driven from one property to the other dozens of times. It's like a 3-minute drive. What it allows us to do is operate these 2 properties like it's an 80-unit property, which is a lot more economical, a lot easier to manage than the smaller properties. Why is it easier? Well, with 80 units, you can afford on-site staff. With a 24 unit or a 50 unit all by itself, the on-site staff becomes a lot more expensive. Okay. Now, the other thing that's really nice about this one is you can usually get better pricing on the lower units, right? So we'll talk later. This 24 unit, I almost feel bad for the price we're paying. Almost, I don't really feel bad for the price we're paying, but we're getting this 24 unit at an amazing price. And 56 unit we're getting at a good price, right? But when we talk about best of both worlds, this Blair Street Apartments is owned by one guy. He's been managing the property himself for about 20 years. Listed it with a residential real estate agent, the type of people that sell single family homes. And for that reason, we were able to negotiate quite a good price on it. Okay. sorry, I went the wrong direction. And here we go. All right. Now, talking about where it is, once again, here, this center graphic right here is a snapshot of, Salt Lake City. The downtown area is right up here. All right. We are, this red box here is this inset to the left. Okay. But you have I-15 coming down the middle. You have State Street coming down the middle here. You got I-80 right here, joins I-15, goes this direction. You've got I-215 Belt Route, which pretty much is this, circle area right here. And oops, it runs into I-80 there. And this is the 21st South Freeway. It's got a different name now, Bangor Freeway, but I think 201 is what it is. But sorry, when I was growing up, we always call it the 21st South Freeway, but I think it's Highway 201 now. Incidentally, I was born in this area right here, just towards the edge of the map, and I grew up just north of this map in Davis County. But, zooming in a little bit closer, both these properties are just off of 3rd South, which is one of the main roads. There's only a handful of roads that go underneath the freeway or through this freeway. 3rd South is one of them. Incidentally, we do own Eleanor Rigby Apartments, which is also on 3rd South, not very far from these two as well. So, White Pines right here, Blair Street right there. According to this, 1.2 miles. I believe that because I did actually put it on Google before putting this presentation together. Okay. What is really, really nice about both these properties is how close they are to the freeways as well. Okay. And what does that mean? With you got I-80 right here, I-15 right there. You can get almost anywhere in the Salt Lake Valley within 20 minutes because of how centrally located these are. Okay. So from Blair Street to the freeway, where we're talking from I-80, we're less than a mile, and White Pines to I-15, we're less than a mile as well. And then once you're on any one of those freeways, you can, like I said, you can get almost anywhere in the valley within 20 minutes. Some corners down here you can't quite get to in that 20-minute mark. So very conveniently located for anybody, in that Salt Lake area. All right. 5 minutes from downtown. And it's a really, really, like I said, conveniently located. All right. Investment highlights, purchase price. Both these properties together we're buying at 17 million. We've got a couple slides later where we are breaking that down into, what each property's purchase price was. 80 units. We're looking at a 5 to 10 year hold. I'll explain that in a second. And we're going to need about 7.2 million to be fully capitalized on this project. We have closed on White Pines already. It's a 2-property portfolio. We purchased White Pines on July 25th, so that is now ours. We are still raising money so we can purchase Blair Street Apartments. We should close on that one. We have till September 3rd. We'd like to get that done, before the end of August, but contractually we have till September 3rd to close on it. All right. About the 5 to 10 year hold, the way I look at this is there is a lot of market uncertainty right now. Interest rates have come up really, really fast, which has thrown a wrench into a lot of things. Makes it an amazing buying opportunity right now because of where these are priced. But what I've learned in the years that I've been investing in real estate is you want to try to have a really flexible exit. Okay. More than anything else, the places where, our deals haven't gone as great is essentially when we back ourselves into a corner or paint ourselves into a corner, right? So 5 to 10 years, we'll be looking to sell this as early as possible, but we want to be able to hold it out to 10 years in case it takes that long for the market to correct itself. All right. So that's what we mean by the 5 to 10 year hold. Our investment numbers are based off of a 10-year hold. So when you look at our equity multiple, that's based off of a 10-year hold. The rates of return are very similar, whether we do a 5 or a 10-year hold. Okay. All right. And here's what we're talking about. Here's kind of what this timeline is going to look at. On both properties, we are getting short-term loans, 5 years or less. White Pines, we have a 3-year loan. And on Blair Street, we have a 5-year loan going in. Okay. So this is what the whole period's going to look like. If market conditions, we have this triangle down here for a potential sale. If market conditions are there and we can make a good profit selling, somewhere in that 3 to 5 year mark, we will sell in that 3 to 5 year mark. Okay. I think that's kind of an optimal time frame to maximize profits. We do have, roughly a 2 to 3 year window to refinance both properties. So if rates come down significantly and we want to refinance and hold, we can as well. Okay. And essentially what we're going to be doing is we're going to re-underwrite the properties both directions. What do the returns look like if we hold the property? What do the returns look like if we refinance the property? And what are the returns going to look like, if we sell the property? And, our goal is to maximize returns to our investors. Okay. So this is what the potential is. And like I said, we could be selling in that 3 to 5 year mark. If we feel that holding a little bit longer is going to be better for the investment, we're prepared to do that as well. All right. Now we have two different classes of shares. And actually, this is something we didn't update. We left this opportunity open to non-accredited investors, and we changed the designation of the shares. My apologies. We have Class C shares here, Class D shares here, but for all intents and purposes, we have two different tiers of investments. Basically, for people who are able to invest a little bit more, we have a $250,000 minimum on our Class C shares, and we're offering higher returns for those. And on the next slide, we should have what those numbers look like. But instead of a 6% preferred return, we're giving an 8% preferred return and an 80-20 split. I'll explain those in a second because I know we have a handful of new investors here. And then our class, what will be D shares, minimum investment, we're looking at $100,000. Little bit of wiggle room in that number, but preferred return at 6% with an LPGP split of 75-25. Okay. What does that mean? It means from the profits on the property, we are going to be pushing 100% of the profits out to investors until we have reached the 6% hurdle. Okay. So for $100,000 investment, if we haven't averaged, 6% or more, back to our investors, we as the general partners are not making any money from the profits. Okay. Once we have exceeded a 6% return to our investors, then we revert to this profit split of 75-25, meaning 75% of the profits go to the investors, the people that have money in the deal, and 25% of the profits come to people who are operating the deal. Okay. And so you look over here, obviously an 8% preferred return means that it takes a little bit longer for us to make money, the operators, and it means that the investors at this level are making more money before starting the split. They're getting a higher percentage after we start the split, which makes their returns look a little bit nicer. All right. So for the higher class of shares, we are projecting a 17% IRR and a 21% average annual return, just slightly higher than the numbers we showed earlier. All right. And then for our class, for the lower tier or the general tier of investments, we are looking at this, roughly a 16% IRR and a 19.5, almost a 20% average annual return. So we're looking at just more, slightly higher than a 1% on IRR difference. It's 1.2 difference. We're looking at about a 1.5% difference on the average annual returns. Okay. So yeah, the higher tier of investments are going to get higher returns. All right. All right. Now, when looking at these numbers, once again, I mentioned at the very beginning, I don't have a really good crystal ball. I can't, predict the future. But one thing we do look at is, what's the market like today, and where do we think the market's going to be when we sell? Okay. The we look at what's called a cap rate or an exit cap. Um, when we first got these properties under contract, the average cap rate in the market was about 5.1% for this vintage product. All right. And the cap rate, if you don't understand what a cap rate is, it's almost a multiplier. It's the opposite, but you take the income, you apply a cap rate, and you get a value. Okay, that's what it's like. So higher cap rates correspond to lower values, lower cap rates correspond to higher values. Okay, so the numbers that we are projecting, we are assuming the market when we sell is going to be worse than today. Okay, so our numbers at the exit, we're looking at a 6 cap instead of a 5 cap. Okay, so that's where we're getting our projections. And we think, 10 years from now, we're buying Blair Street at 4.5 million. It appraised just a hair under 5 million. But we're assuming that 10 years from now, we'll be able to sell that property about 7.75 million. We're buying this one at 13 or just a hair under, or we bought it at 13, and we're assuming 10 years from now, at that 6% cap rate, it's going to be worth 21 million. Okay. If the market, at sale is about the same as today, we're going to have slightly higher sale prices. If it's slightly better than today, we're looking at a cap rate of 4.8. Here's what we're projecting our sale prices to be. And if we go back to the peak of the last cycle, which was May of 2022, market cap rate in Salt Lake City was pretty close to 4.0. If we get back down to a 4.0, we will sell. I mean, if I see a 4 cap in Salt Lake City again, if I can sell either one of these properties at a 4 cap, we're going to do it. But that gives us a much higher IRR than we're projecting. So, what are we projecting on our returns? We're projecting a market that is slightly worse than right now. Roughly a full percentage higher on the cap rate. 90 basis points. All right. Okay. Now, sources and uses, this is where all the money is coming from, where all the money is going. Okay, we already mentioned that we need 7.2 million in equity from the investors. We are getting approximately 12.1 million in loans, and we have some good news about the loan. That's going to be an update from a future slide, but so 19.3 million is our total capitalization. And here's where we're using it. We have a $17 million, $17.4 million combined purchase price, roughly a $400,000 acquisition fee with closing costs, financing costs, prepaid interest, reserves, and our capital improvements budget. That brings us up to exactly 19.3 million. Okay. One thing I would like to point out is we do distributions quarterly. And we typically will withhold the first distribution at the 3-month mark. We do calendar quarters, so January through March, April through June, and the month following the end of the calendar quarter is when we do the distributions. Okay, so closing on this property, excuse me, closing at this property at the end of August, the end of the quarter is September, meaning that distribution would go out in October. Like I said, we'll usually withhold that first distribution because it's almost never a full quarter, and the first couple of months of operations, tend to be a little bit turbulent because we're still getting utilities put in our name. The first month anyway. I'm going down a rabbit hole I don't think I need to go down, but bottom line, the first month, we don't have a full month of income, we don't have a full month of expenses. In the second month, a lot of times we don't even have our utilities, set up and running right as well. So anyway, that first couple of months, it's hard to establish a baseline. So expect the first distribution to be in the second calendar quarter of ownership, right? Okay. Awesome. Now, if you have questions, this is a good place. I'm at a stopping point. So if you have questions, now's a good time to type them in. So, and I'll take a deep breath here. Okay. So we are going to talk about the properties in general. And once again, Stephen, please stop me if there are questions. I see, okay. Oh, That's what Stephen wrote in there. Got it. So talk about White Pines apartment. This is the one we closed on July 25th. As of yesterday, there were 3 vacant units out of 56. That puts us right around 95% occupancy. They have 2 move-ins. We still not used to calling this my property yet. We've been talking about this for so long, but we have 2 move-ins before the end of the week. So by the end of the week, we should hit roughly, 98% occupancy. All right, solid property, solid occupancy history, really, really good location. Um, the previous owners did interior renovations and they didn't do a real full exterior renovation. So when we look at our plan on this property, we're going to bring roughly $500,000 into the property in renovations, right? I mean, you look at the pictures and the pictures look really nice. I noticed Jake Miles, our broker, is on the call. He probably took this picture. This came straight out of their marketing book, not ours. But the property is in very good condition. But we feel that oops, that's not what I meant to do. We feel that there's a lot of value to be added on the exterior renovations. We'll talk about where we're going to be doing a lot of that. So right here, I mean, a little bit of the value add is we're going to be a little bit more efficient with management. The previous owners were happy to keep it full. They weren't really pushing rents. Okay, so when you look at the average rent, we talked with our property manager yesterday, and they're right in the middle of the pack as far as rents, which is a good spot to be if you want to keep things absolutely full. But we feel there's a little bit of room to push rents up while maintaining near 100% occupancy. So part of what we're going to be doing is, be slightly more aggressive with rents and, try to keep our average occupancy around that 95% mark and go from there. Okay. Now, this is something that they've actually fixed before we purchased the property. The pet rent and some of the other fees. When we did due diligence on the property and we were underwriting the property, they weren't charging every unit fees for parking, fees for storage, fees for pets, fees for everything else. But in the last couple of months, while we had it under contract, as leases were renewing, as new people were coming in, they were starting to add these fees. So one nice thing is we get all of the benefit of, these fees without having to actually implement them ourselves. Okay. Now, as far as additional storage, there's currently 25 storage units there. There's 56 units. We are going to build, another 31 storage units. So there's one storage unit per apartment unit. And we are going to make everybody rent one. All right, pretty simple. Right now they're renting out for about $40 a month. When I say about, I mean exactly $40 a month. And that's where we're going to start the rental prices there. Okay, that should generate, just building the extra storage units should generate about $12,000 in income, which is a good thing. And then we're going to throw some amenities out there and we're going to make the exterior look a lot nicer. A couple things, we don't have a picture of it, but they used to have a pool at this property. Pools in Salt Lake City don't do well. You can only use them 3 months a year, especially at apartments. You can only use them 3 months a year. And this isn't a large enough property to really maintain it, but somewhere along the line, they filled in the pool and, laid concrete over it. And so there's a concrete pad that just doesn't really belong. So one of the things we're going to do is we're going to take that concrete pad out. We're going to put a pergola in, custom built gas grill, benches, off-leash dog area, and add a couple of amenities there. All right. A couple other things that we've noticed is, a lot of the decks and a lot of the entryways, when I say decks, that's the top row. If it's a 2-story building, it's very common in Utah for properties to have basements. And so we do have basement or below grade apartments. So the entryways going down and the decks going up have not been maintained well over the years. And so we're going to be putting about 125, $130,000 into making the entryways look really sharp. Okay. So as far as the upgrades, those are the main upgrades that I think the tenants are really going to appreciate. A couple other things that we are going to be doing. There's a lot of potholes. The asphalt is very old. We're going to make the asphalt look black again. That's one of my favorite things to do. I mean, call me crazy. I like apartments that have really black asphalt and really sharp lines on there. But so we're also going to be redoing the entire asphalt, get rid of all of the potholes, alligator cracks, all other fun stuff as well. Um, and then there's one roof that has to be redone. Stephen, what am I missing on our renovations? Did I hit everything? I think I
Yep,
hit
you
it.
got everything.
Got everything. Okay. So that's the renovation plan. And one thing that I've realized over time, a lot of people who know me, I spent 20 years active duty in the military. We moved 12 times, right? So moving 12 times, my wife and I had to look at places like this very frequently. But my wife, if we showed up to an apartment complex and the entryway looked terrible, she'd just look at me and say, Brian, I don't even want to go in. Okay. So what we're trying to do is make sure that there's no reason before people get to the beautiful interiors, and the interiors they do look amazing. We want to make sure there's no reason for people to turn around before they hit the interiors. Okay. I'm going to zoom in a little bit here. This is what one of the renovated decks look like. There's a total of 16 decks. We're going to have to renovate all of them but three. 14 decks. We're going to have to renovate all but three. Okay. And this is what one of the renovated decks looks like already with the Trex decking. The other ones have carpet, kind of industrial carpet, doesn't look good. But bottom line, we want to make entry, from the moment they drive onto that apartment complex. We want the black asphalt. We want the sharp yellow lines. We want the new amenities. We want the entryways to look amazing. And we want them to come away thinking that the whole property is awesome and not just the interiors. Okay. And what that should do for us is we're going to get more people interested. We're going to get a higher close rate, which means our vacancies are going to be lower. And we're also going to be able to push rents up, quite a bit. All right. So that's White Pines. Right now, let's talk about Blair Street. Okay. Couple of blocks north of White Pines. It's right next to the Nibley Golf Course. I'm a terrible golfer, but I did hit par on a hole once at that Nibley Golf Course, and that had me super excited. That's how good of a golfer I am. I've hit par once. But anyway, what's really nice about this, every person we've taken a handful of investors to these properties. But everybody that has gone from Blair Street to White Pines or back and forth has always said, I would much rather live at Blair Street. Okay. We are buying Blair Street at 185,000 per unit. We bought White Pines at 230. Okay. So we're looking at about a $50,000 per unit discount, 45, but about a $45,000 per unit discount. And right now the rents at Blair Street are about $250 on average lower than White Pines. Okay, so when we look at the opportunities here, like I said, 100% of the people that have made a comment about where they'd rather live would rather live at Blair Street. And I agree, me looking at the two, I'd rather live at Blair Street as well. So it's on a cul-de-sac on a quiet road. So it's much quieter. Anyway, just a really, really well-maintained property. Very similar to White Pines in age, and very similar in that the interiors are in great condition. The exterior, we are going to put probably about $250,000 into the exteriors here to make it look a little bit nicer. Okay. And going over our plan here, this was owner operated. One guy managed this property for 20 years. When he was out of town, there was nobody to do things, and that's kind of consistent over the 20 years. But for a single person managing the apartment complex, I think he did amazingly well. But it wasn't professional management. So a lot of what we're going to be able to do is plain and simply, we're going to manage it effectively. Okay, we're going to put professional property management on there, and we are going to be charging, market rates for the leases. What it looks like the owner has been doing is, essentially the least amount of work possible to get new tenants. Okay, so if market rates on the property are 1,500, he was putting rents at 1,350. Roughly about a 10 to 15% discount between market and what's actually on the books right now. And essentially, every time he would advertise it, he would have a new tenant within a week. And it's the easy way of operating. But as leases come due, we are going to bring, them back up to market rates. Laundry income, there is a laundry room on site, 3 washers, 3 dryers. Actually, I think it's 4 washers, 4 dryers, but they are all coin operated. Not a lot of people carry coins around. Talked to one resident, and they said they actually take their laundry somewhere else because, there's a laundromat close by that has, easier for them to pay. So we are going to replace the coin operated laundry with app-based laundry. They are not fully recouping the utilities, so we're going to charge more for utility income and other income line items as well that are very common in the neighborhood, like the common area maintenance line items. There's a lot of line items they're charging in the Salt Lake Metro that are not being charged here. And we're essentially going to bring this up to what the market is commanding right now. Okay. Now, on the exterior, we are going to make it look a lot better. One thing, I hate mansard roofs. If you don't know what a mansard roof is, this is it right here. It's the shingles on the side. And so we are going to, the bulk of our money is going to go into the exterior right here. Getting rid of the shingles. Oh, by the way, there are a couple of active leaks, on this, because of how this is done. You look at the soffit underneath there, and most of it is kind of waterlogged. So this is not just cosmetic, but we are going to very much take care of the cosmetics. So this is the before and after pictures. Like I said, interiors already look really, really sharp. And so we're not going to be doing a lot on the interiors. We're going to be maintaining interiors. All right. So anyway, the plan on both these properties, in a nutshell, is we're going to make the exteriors look really sharp, keep the interiors looking as good as they are right now, and manage them, more appropriately for the market. All right. So those are the 2 properties. Same thing. We are at a kind of a pausing point. So anybody has questions, go ahead and now's a great time to drop them in. All right. So looking at the numbers, we underwrote both properties, separately, and it's really hard, even though I do have 2 degrees in math, so I could really nerd out on this slide. Most people I know don't want, to be nerded out on the spreadsheet slide on a Zoom call. So, we have this available to everybody, but what I really want to point out is when you look at our rent bumps, year one, we're looking at recapturing a lot of the loss to lease is what we call it. But if you look at where we're going, year one gross rent from 416 to 430, 430 to 448, we are making very modest increases to our rents, on an annual basis. Okay. So we are not trying to push the limits. We are not really trying to stretch things on this property, though we probably can a lot more because of where the rent points are. Okay. So, we're not really looking at being super aggressive in our underwriting model here. All right. And then, looking at our operating expenses, essentially what we do with our operating expenses is we take what the owner's been paying, add a little bit of a buffer. We look at the historic operating expenses, And we do the same thing with our operating expenses that we're doing with our income is every year we're ratcheting them up, due to inflation. So one thing that is really nice, a lot of other states have had problems with these two lines here, property taxes and insurance. Utah is one of the best states for insurance. Um, Not a lot of tornadoes happen there, not a lot of hurricanes happen there, not a lot of flooding happens. They are close to a fault line, but there's not a whole lot of natural disasters. So our insurance rates are fairly low compared to the rest of the nation. And it is one of the states that has the lowest property taxes in the nation as well. So we haven't seen a lot of hikes in either of those areas in Salt Lake City. So um, that does help us a lot compared to like your Texases or Florida that have seen like double-digit increases on both those line items in the last couple of years. All right. White Pines, same thing. Our gross rents year one, we're expecting about $1 million. And once again, you look at our gross rents and, our numbers are only going up a little bit every single year. Okay. We're not really super aggressive on pushing the rents in our underwriting. And then the same thing on our expenses as well. We're moving our expenses up every single year like normally happens. All right. Okay, now we're going to talk about financing. White Pines. This is essentially what we got. And we actually got about $60,000 less than this amount, but for the most part, accurate. We just got some really, really good news 2 days ago, and I forgot to update the slides, but we thought we were going to get an interest rate around 5.7. We're actually going to be at five and a quarter on our interest rates. So the loan on Blair Street is a Freddie Mac loan. The loan package is with Freddie Mac right now for final approval. But it looks like we're going to get another $100,000 in loan proceeds, which does help everybody out. And we're going to get a 5.25 interest rate instead of a 5.7, which does help everybody else out. So 5-year term on this property and 3 years of interest only is what we're getting. So we're not doing the full payment until year 4, which should help out with our cash flow significantly. White Pines Apartments, we did a bridge loan, and before you gasp, it's a much different operating environment right now than it was 2 or 3 years ago. There are a lot of bridge loans that are going bad right now, but they were the opposite. They started with a low rate and rates went up. We're starting with a high rate and expect rates to come down. We do have a rate cap, however, so if rates happen to go up from here, we are insulated with the rate cap. And basically what a rate cap is, it's an insurance policy where somebody else is going to pay the difference between, our cap and whatever the loan payment is every month if rates do go up. So we did purchase a rate cap. So we will not pay more than, 9.5%. And then with the White Pines, the lender on this one is paying for the like part of that loan is the renovation budget. So, this 0.45 million on the back end is what they're holding back for us to renovate the property with. So we are wrapping the renovation costs in with the loan, which is why we went on a bridge loan on this property. But what we expect, it's a 2-year loan. We could actually extend it out to 3 years. So we have a 3-year runway to refinance. And if you've been paying attention to the market news right now, the market, when I say the market, when you look at the future tradings on the stock market, the futures right now say there's a 60% chance that the Fed will drop rates by 0.5% next month. Okay. So we're at that point where we should start seeing rates coming down, which, when we look at what our business plan is, we want to refinance this property as soon as possible. So we're going to go in, we're going to get the renovations done as soon as possible. We've already started talking with our general contractor, and they're working on final estimates right now. So bottom line on this one, it is a bridge loan, but bridge loans are bad when rates go up. Bridge loans are perfectly fine when rates are stable or going down. So, and then overall, one thing I'd like to point out, our loan to value on Blair Street's 58%. That's a very low risk loan, and our loan to value on White Pines ended up being a hair below 70%. So once again, there's a little bit of risk with that floating rate, but we have a low loan to value and rates should be coming down. We should be able to refinance out pretty quickly. In worst case scenario, if rates don't come down, 1 to 2 years from now, we can still refinance this loan at similar terms as today. All right. Now, here's what the projected returns are going to look like. And this is the Class C shares with a $250,000 invested. And what I will point out, that first year's number, is not very sexy. Okay, but there's a reason why. When we purchase value add properties, we're going to be doing a lot of the work in that first year or two. Okay, so have our construction crews out. With Blair Street specifically, we are starting with 12-month leases on every unit, and they're going to be at lower rent points than we're going to end up. So the first year, we're going to have a lower cash on cash. This is very typical of value add products. We are projecting the refinance on White Pines to be during year 2. We expect to be able to do a cash out refinance and return some of investor capital back to them. And then after that, the cash flow should be pretty strong. Projecting the refinance on Blair Street around the year 5. Well, we are projecting it year 5 for the terms of our underwriting, and then we're projecting selling both properties at year 10. Okay. Now, in reality, like I said earlier, we will, when it comes time, when we get towards the end of that first loan with White Pines, we're going to look at both options. What does it look like for us to refinance? What does it look like for us to sell? All right. If the cards look better selling, we could sell White Pines as early as 18 months to 2 years. But right now we are planning on that first refinance and holding it longer. Same thing for Blair Street. We are projecting a 5-year refinance on Blair Street. If the numbers look good to refinance at year 3, we'll refinance as early as year 3. And if it looks good, if numbers look good to sell, we will potentially sell as well. All right. Anyway, like I said earlier, I do want to maintain a fair amount of flexibility on the property, on the exit, to give us the opportunity to pivot if the market tells us we need to pivot. All right, similar numbers for $100,000 invested. It's a little easier to tell percentages with 100,000 as your denominator. So the first year, we're going to be above 1% average returns. Like I said, not very sexy. But once we do that first refinance, if we were to refinance this property today into a permanent loan, we would go from a 9.5% interest rate to a 5.25%, 5.5% interest rate. So that's going to necessarily increase the cash flow. And so we should expect to see cash flow be significantly higher years 3 and beyond. Okay, from essentially that first refinance and beyond. All right. And those are the numbers. Okay. Once again, great spot to pause and ask questions if anybody has them. But we're going to go in and we're going to talk about Salt Lake City. All right. So, why Salt Lake City? Well, I was born and raised in Salt Lake City. I might be a little bit biased. I think it's still my favorite city in the U.S. Maybe not my favorite city in the world, but pretty close. This is an article from Wall Street Journal in April. It says Utah has hands down the hottest job market. All right. Some of the words in here were bucking the trend. We've seen jobs reports in the last month look, pretty gloomy nationwide. Salt Lake City is still, leading the nation as far as, what the unemployment rate is, leading the nation with low unemployment rates, and job market is still super strong in Salt Lake. All right. U.S. News and World Report for the second year in a row has said Utah is the best state. I learned that Utah was the best state, in elementary school, singing that 50 Nifty song. I'm sure everybody, knows what I'm talking about, but um, anyway, US News has them, best state 2 years in a row. A lot of other, recent polls have come out. There was one came out last week where Utah was at the top of the list, best places to live on this one. Um, and that was a Consumer Report one. So anyway, lots of good reasons to invest there. Here we go right here. Salt Lake 2034 Olympics. Olympics are coming back to Salt Lake. And here's one that I really, really like. Utah ranked state with the best economic outlook for 17th consecutive year. All right. So anyway, I appreciate this one because 17 years straight, a third party organization. It's the best economic outlook. Wait. I'll find the source to this one. It's the ALEC, the Laffer State Economic Competitiveness Index. And this is on the Rich States, Poor States website. But 17 consecutive years with Utah on top, says this particular poll. But um, we already talked about best state. US News had it ranked as the best economy in 2023 and the second best economy in 2024. All right. Um, really, really high growth rate between the 2000 and 2010 census. The state of Utah was third in the nation as far as growth rate. Between 2010 and 2020 census, Utah was first in the nation in growth rate. And I know I'm talking about a state and not a city. Right around 90% of the population resides along that Wasatch Front, which is the greater Salt Lake metro. So when we talk about Salt Lake City, the greater Salt Lake metro is about 90% of the population. Salt Lake County is just over 1/3. All right, but a lot of accolades here. Number one state in economic outlook, number one state for middle class. The Milliken report ranks cities, and Salt Lake City was the number 4 in the nation. Provo-Orem was number 5. One other person that thinks Utah is better than BYU, Stephen, by the way. And then Ogden Clearfield, which is where I grew up, was actually number 19. But lots of good reasons to invest in Utah. The economy is going extremely well. Lots of people are moving there. All right. Some other stats, this is, Salt Lake County, 1.2 million roughly. But when you add, Davis, Weber, and Utah counties, and then like the Park City area, the Wasatch Front's about 2.8 million. Median income is fairly high compared to the rest of the country. The report that came out last week basically said that the median income compared to the cost of living is the best in the nation, which means people can afford rents, which is a really nice thing if you're trying to rent apartments there. Unemployment 3%, well below the national average. This number is now 2 months old. But the unemployment rate in the nation is about 5 right now. And then median age in the state of Utah, it is the youngest state in the nation. Average age in the US is 39 years old. Median age in Salt Lake is 33. Okay, what does that tell you? There's a higher percentage of the population that is in that renting phase. So, we've got more young people there. We also have a much higher birth rate in Utah and in Salt Lake specifically than other areas, which means, we're going to have a lot of natural population growth, over the next several years. Okay. Median age of 33 compared to a median age of 39 just means there's a lot more people that are going to be able to reproduce and increase that population. All right. Utah's name is Crossroads of the West. 2 major freeways coming through. I-80 is a coast-to-coast freeway, and I-15 is, essentially from the border with Mexico to the border of Canada. All right. Not necessarily true. It actually, in San Diego County, goes from I-15 to Highway 15, US Highway 15, which goes all the way to the border. But essentially, it's the same road. Salt Lake City Airport just had a $5 billion renovation. It is the 20th busiest airport in the nation. And there's a lot of cargo and freight that comes through it. And major intercontinental railroads also come through the state of Utah. Um, so, as far as, goods and service goods coming through the state, there a lot of, I think I heard a stat, I couldn't find this verified, but somebody told me once that 80% of the goods that go from one coast to another coast travel through Utah. So, either by rail or by freeway. So lots of stuff moving in and out, which really helps. All right, workforce. We are really, really close. So here's the two stars. The hot spots for business. Sugar House is a great place. A lot of offices right along, like a lot of jobs right along the I-80 freeway corridor. A lot of jobs right along the I-15 corridor, and a lot of jobs downtown. And these two properties are very well located to take advantage of the workforce. Another accolade that didn't make the cut here, Salt Lake City was ranked in one study as having the fifth most diversified economy. So that's something else it has going for it. All right, education, lots of really, really good universities in the area. And Stephen's very happy that I left BYU on here. We did go to rival colleges. I'm a Utah graduate. He's a BYU graduate. So anyway, and in the Salt Lake area, Salt Lake County, there's a lot of different colleges and colleges and universities. And the property we're at is probably a 12-minute drive from the University of Utah, about a 10-minute drive to Westminster. Salt Lake Community College has several campuses, and it's super close to that as well. So, whether the tenants are into higher education or just working, there's lots of opportunities really, really close. All right. Now, I should talk about myself more because, looking at the management, basically the buck stops here. Over the last 6, 7 years, 7 years, I've been general partner on over 1,500 units. Where as soon as we close on Blair Street, I top 1,600 units. I have come full cycle on 9 separate properties totaling 600 units. Average annual return that I've been able to produce for investors is 19.5%. Okay, which is a fairly good number considering where we are in the market right now. And we look at that 19.5%, the range of returns. We did have one property that was a little bit of a dud. We bought it in Augusta, Georgia, which was rip roaring when we bought it, but Augusta actually currently has the highest vacancy rate in the nation right now. Anyway, long story short, got one property that gave a 5% annual return. Most of the other properties fell in that 15 to 25% annual return, and 2 of the 9 properties were low 30s, and 1 of the 9 properties was at a 40% annualized return. So, looking at what I've been able to produce for our investors, average return just a hair under 20%. Okay. Have not had a single loan go bad, and that's something that's happening a lot right now. And fortunately, prior to the rate hike cycle, I had 0 variable rate loans. We now have 2 variable rate loans on the book, but both of those were secured when rates were high. And like I said, variable rate loans when rates are expected to go down are awesome. They're terrible when rates go up. So that's essentially what my experience is. 9 for 9 on making a profit, a range of profits from 5% to 41%, with the average coming in at 19.5. All right. A little bit more about me. Like I said, born and raised in the Salt Lake City area. I have my 25-year-old daughter lives not very far from these apartments, and my 22-year-old daughter, well, I used to be able to say that she lived 3 blocks away from Blair Street. She moved 2 weeks ago to Seattle, but um, anyway, as far as that goes, I think Utah is a great state to invest. I think Salt Lake City is my favorite city in the nation. Um, I think I do like Rio better. We lived in Rio for a while, but um, yeah, I think Salt Lake City is a great place for investments because of the dynamics going on there. And these two properties, have extreme confidence that we're going to do very, very well with these properties going forward. And once again, we are kind of getting the best of both worlds. We're getting really solid pricing on this portfolio together, and we're going to be able to manage it like an 80 unit property. So we get all the benefits of having a larger property with the pricing of smaller properties. All right. Um, Now, if you came to this, if Stephen or I invited you, this is, how you would invest. If you were invited by anybody else, to this deal, reach out to them as far as investing. It's going to be a slightly different link to get into our portfolio. We use investment portal called Invest Next. But like I said, every person has a slightly different link to get the investors in there, but it's going to be the exact same process for everybody. All right. So if you want to invest, easiest way for most people is to go into the investment portal, create a profile for yourself, do what's called a soft commit, which basically you type in the number you want to invest and you hit enter. That's what a soft commit is. And then after that, once again, this is restricted to accredited investors only. There is a spot where you are going to have to upload a document proving you're accredited. Sorry about that. That is a rule that I have to abide by. You can get accreditation letters from accountants, from attorneys, from anybody with a credential is what I ask. Okay, somebody, an attorney's got, a license to operate, accountants, CPAs, things like that. So you can go get that generated by yourself. Financial planners can do it as well, but somebody who can say you're accredited. Another option is there are services that will do accreditation. But the easiest thing is if you go just through this Invest Next process, there is a spot where you can upload, certain documents to prove that you're accredited. And, we pay a fee for somebody to review that and, put a check in the box. Okay. So unfortunately, we are legally bound by that. It is kind of annoying. I get it, but um, we do have to follow the law on that one. And then once you upload your accreditation letter, there's a couple of documents that you have to sign, and then you wire the funds. Okay. Timeline, and I'm realizing right now I should have had a timeline slide, but timeline for the investments, we're closing on Blair Street. August 30th is our target for the close. So we would like money, commitments made and money wired by the end of next week, which is the 23rd. We will obviously take investments until we're fully funded, but just to make sure that we have enough money in the bank to close. Friday the 23rd is our target for that. Okay. If for some reason you missed that target and you still want to invest, like I said, we will still take investments until we reach that 7.2 million mark. So that said, any questions? All right. Now, some of the other co-GPs, Carly, Evan is on here. Evan and Jared are working together. We've got, our Cove One, Joe team on here. We've got Joe. I didn't see BJ. Oh, hey, Lee Malstead's on here. Lee, gosh, I haven't seen you in a long time. Michael J. Freer, Pete Turner, Kenton Johnson, and a couple more are, helping us with this project. It does take a quite a sizable team to be able to put a deal like this together and operate it. And so that's what we do have. So